Welcome to the first episode of the M3 Report, which you'll be glad to hear is not a show about my favourite 51-kilometre stretch of the Irish motorway between Clonee and the historic town of Kells, but instead it's about metals, markets and money. The M3 Report will take an irreverent look at financial markets and the doublespeak of policymakers to help you better understand what's really going on with your money. I'm your host, Dave Russell of GoldCore.com, the leading precious metals dealer. And previously, you'll have seen me cropping up in various different GoldCore TV antics. And now I'm here bringing you our latest and most exciting offering. GoldCore TV has always been about bringing you conversations with market-leading commentators and analysts and stakeholders. And be sure to subscribe if you missed any of those. But we do this because there's no way that we can bring you the full picture of all the madness that's going on without the insights of these great minds. But we're changing this up. We're going to keep bringing you forward-thinking interviews, but also our own thoughts from the perspective of a market-leading precious metals dealer, as well as chart analysis and some fun highlights along the way. We're excited to bring you this new format as we believe that there's so much at stake with far too enormous consequences for people not to hear thoughts and research from all sides so that they can form their own opinions about how they should manage their investments. Coming up, we have our interview with best-selling author Jim Rickards, who talks about behavioral manipulation in financial markets and why history shows that trusting your government is not always a good idea. Then we have the fantastic Gareth Soloway of In the Money Stocks in Chart Watch, giving us a summary of what's going on from a technical perspective in gold, silver, and anything else that has grabbed his attention. And please don't miss Jim Rickards playing Fire, Hire, Admire, our quickfire round where we ask our guests to call out a person in a position of power or influence that they'd fire, someone they'd hire, and someone they admire. But first, we caught up with Jim to discuss how policymakers, central bankers, and even the White House continuously attempt to manage and manipulate our perception of what's really going on with the economy. Jim Rickards, welcome to GoldCore TV.
Thank you, Dave. It's great to be with you.
It's a pleasure to have you. Now, I just want to refer to a tweet, or part of a tweet that you circulated recently, which says, in the battle between propaganda and reality, propaganda wins in the short run, but reality always wins in the long run. Now, you've talked about behavioral manipulation in the past, and we're discussing perception and the manipulation of perception. And recently, we've had the White House press secretary trying to convince us that the US economy is in a strong place. We have Biden, who is trying to convince us that inflation is down to Putin's price hike. And we've also have JP Morgan's Jamie Dimon telling us to prepare for an economic hurricane. So there's definite attempt to establish a narrative here and control perception. What does Jim Rickards see when he looks at the current state of financial markets?
Well, I think that's a pretty good summary. The tweet just meant, what is propaganda? Propaganda usually comes from the government, although there are a lot of enablers, whether it's big tech or Wall Street or the media. So there are a lot of amplifiers, but usually can be sourced to the government. It's designed to create a perception, persuade people of certain things. Unfortunately, people tend to trust their governments. I think that's probably a bad idea. I think history says it's usually a bad idea, not always, but usually. So in the first instance, people hear the government say, the economy's fine, or unemployment's near an all-time low, which actually statistically is true, and they kind of nod and go, yeah, it's all good. And then reality is the stuff that hits you in the head like a 2x4, which is, you go to the gas station and with US dollar prices anyway, ones I'm familiar with. It used to be $45 to fill up your tank. Now it's $85 or $90. I don't drive a pickup truck, but I hear from the F-150, the Ford F-150 is the most popular pickup truck in America. I think they sell more of them than they do cars, but those I think are now up to like $150 to fill it up, probably a 20-gallon tank. So that's the reality. So all of a sudden you're like, well, wait a second. White House is saying it's all good, but the price of gas has doubled. And then there are all kinds of ripple effects from that, which is, you have to fill up your car. You've got to put food on the table. You got to pay for the roof over your head. If all those things are costing more, which they are, that's very clear. That's less money for everything else. Maybe you're not taking your spouse out to dinner on Friday. Maybe you're not buying new clothes or taking a vacation. You're going to cut out all those other things. So yeah, you're spending money but on the necessities, but it means there's demand destruction on any thing that's not necessary, and that's a big part of the economy because of service sector and all the people who cater to that. So the propaganda is positive. We can talk about that in a little more detail. The reality is harsh, and reality wins. Because you're paying real money, as I described. You mentioned the word narrative, and that's really important. And there's a very good book on this by Robert Schiller, Nobel Prize winning economist at Yale University. I'm not a huge fan of your garden variety PhD economists, but there are some good ones out there, and he's one of them. He wrote a book about 2 years ago, maybe a little bit less, called Narrative Economics. He said, yeah, we got all the models and Phillips curve and wealth effect and various quantity theory of money, and some have a place, some are more valuable than others, but don't underestimate the power of a narrative. A narrative is a story. It's basically it's a fancy name for a story, but a story that persists, that grows. And interestingly, and I'd done this some years ago, it was interesting to see he glommed onto the same model, which I think is really perceptive. In epidemiology, of course, we've just come through a pandemic, right? So, and that we're all, kind of amateur epidemiologists, but I had studied it for other reasons. There's a model called the SCIR model that stands for susceptible. Are you susceptible to a virus? E for exposed. Are you exposed to it? I, are you infected? Did you get it? And R, did you recover? The difference between I and R are people who died. But it's a model, and it's mathematically based, and it's empirically validated of how viruses spread exponentially. And you can also use it to forecast how a virus is going to go. I wouldn't listen much to the Imperial College in London, but there are other people who do some pretty good forecasting with that. Well, what Schiller did, he took that model, moved it over to economics, and took a narrative kind of like a virus, not in a negative sense, but just as something that spreads. And it can be very powerful, and then eventually may die out or reverse, but it can be powerful in the meantime. That much I knew, but what I learned from the book that I hadn't really thought about is that narratives don't have to be true. They can be true, and they can be very powerful, but a narrative can be false and still be powerful. If it's the self-fulfilling prophecy, if enough people believe it, it sort of becomes the reality to some extent, even if it's based on false premises. He gives an example during the Great Depression. The Great Depression really was two technical recessions, but there was a period from 1929 to 1933, election of Franklin Delano Roosevelt. And then there was another period from 1933 to 1937. The 37 and 1940 part we leave aside for this purpose. But during the first part of the Great Depression, unemployment was high, productivity was, output was dropping, trade was dropping. It was a very, very bad time, no doubt about it. But not everybody was out of work. Not everybody was poor. There were a lot of people with a lot of money at the time, but it was felt that being ostentatious was poor form. It's like, okay, I'm lucky I have a job, I've got some money, but I'm not going to buy a new car, buy a big house, or flash it around or whatever, because it's really not considerate of all the people who actually have fallen on hard times. Well, that was the narrative, but it's the worst possible economic advice, because it's precisely the fact that people with the money should keep spending that kind of can boost the economy out of a depression. So by people saying, well, even though I have the money, I'm not going to spend it because it's poor form, we're actually prolonging the Great Depression. Now, when FDR came along, was elected in 1933, became president in 1934, the psychology turned 180 degrees, and all of a sudden, the Democratic campaign song was "Happy Days Are Here Again," and FDR seemed to solve the banking crisis and so forth. And all of a sudden, it became okay to spend money. Well, in the middle of the Great Depression, 1934 to 1936, those were some of the strongest years ever for the stock market. And unemployment did come down a lot. Now, the problem is it came down from like 25% to 15%. Well, 15% is still, painfully high, but it was a big move in the right direction. So he describes how the narrative flipped from don't spend money, it's poor form, to, yeah, go spend money and help the economy. None of that is taught in business school. It's not taught in economics. It can be modeled using this epidemiology model, but it doesn't fit into any of the standard macroeconomic models, but it's powerful stuff. And so today what's going on is that the White House is trying to push a narrative, and they're failing badly. But they'll say, if you listen to deliberations among White House officials, you know, some of the stuff leaks to the press, and I know some of these people. It's like the economy is great, unemployment's really low. We've created all these jobs since the pandemic, but we're doing a really bad job of messaging. We can't, you know, Biden is screaming at his staff. The communication staff are quitting in droves. Kamala Harris is a joke. I mean, forget her. But the point is, they're inside the White House. They're frustrated that the positive economic story is not getting out. The correct analysis is that there is no positive economic story. The economy is in terrible shape. The problem is not the messaging; it's the message. And this is why I say the propaganda from the White House that things are great is at odds with the reality, which is things are not great. Let me give you some specific data points, because as I say, I don't like to make statements like this without backing it up. So first quarter, you know, I do, you know, a fair number of interviews, and I'm frequently asked, Jim, are we going to have a recession? And if so, when do you expect it? And my answer is, we may be in a recession right now and not know it. And here's why. The classic, or the accepted definition of a recession is 2 consecutive quarters of declining GDP. There's a few bells and whistles around it, but basically 2 consecutive quarters of declining GDP is the definition of a recession. Well, US growth in the first quarter of 2022 was negative. It was negative 1.5%. The best estimate, and this is from the Federal Reserve Bank of Atlanta, GDP now, it's not perfect, but it's, you know, my experience, it's the best estimate out there, is projecting second quarter GDP at 0.9%, not 9%, but 0.9%. Well, you take negative 1.5 and 0.9, add them together, that indicates a loss for the first half. It wouldn't necessarily be 2 consecutive quarters of declining GDP, because we might, you know, scrape through to some positive growth in the second quarter, but maybe not. I mean, 0.9% is a rounding error from negative. And so we could actually be in a recession and not know. So that's the reality. Happy talk won't work. You know, narratives are powerful, but reality is more powerful.
And then if we talk about Putin's price hike, I mean, obviously when they talk about the US economy being strong, it's obvious with respect to what that motivation is there. But when it comes to Putin's price hike, is that just purely political, saying it's not our fault?
The Putin price hike, I'll give the writer credit for good alliteration. You know, Putin Price Hike. Okay, I'm a writer, so hey, nice job. But it's completely false. Number one, the inflation was going up long before the war in Ukraine started. So if everything was great until February 27th, and then Russia invades, and then all of a sudden the inflation goes up. All right, let's talk about it. But that's not true. This inflation goes back to late 2021. It was persistent in the fall. We all remember the Fed and the Treasury saying transitory, transitory, transitory. And then finally, I think Jay Powell was testifying before Congress in, I want to say January, you know, could have been early February, but he said, it's time to retire the word transitory. So that was his way of throwing in the towel. And Janet Yellen admitted she was mistaken also. So it predates the war, number one. Number two, oh, gee, energy prices are going up because there's a war with Russia. Well, I wonder why that is. Well, the reason is not because Putin invaded Ukraine, it's because the US counterattacked with financial sanctions. Now, bear in mind, go back to January 21st, 2021, when Biden was sworn in as president, and then went back to the White House. What was the first thing he did? He closed the Keystone XL pipeline. This is a pipeline that would bring oil from Alberta, Canada, into the United States, where it would connect at a hub. I believe it's in Kansas, but you know, somewhere in the central United States. And then the hub distributes it to the entire country. So he shut down that pipeline, which curtailed the supply of oil from Canada. Then ended new leasing, oil and gas exploration leasing on federal lands, handicapped the fracking industry, and took a number of other steps using environmental tools, climate alarm, government subsidies, et cetera, to basically, to the extent possible, shut down the US energy industry as much as possible. Now, you can't shut down completely, of course, but everything happens at the margin. And then we end up with oil prices doubling or tripling really from $40 to $120 in under a year, which is comparable to what happened in 1973 with the Arab oil embargo. And then Biden wakes up and says, guess we need more oil. And so he wants to reopen leasing. I said they shut it down. They did, but he wants to reopen it. He's begging Saudi Arabia to pump more. Saudi Arabia is kind of not returning his phone calls. He's begging Venezuela to pump more. Oh, great. The greatest pariah dictator in the Western Hemisphere, and we're begging him for oil. So why don't we drill our own oil? Because we were a net exporter up until 2021. And then Biden came in and we lost that edge and became a net importer, including recently buying oil from Russia. They curtailed that for political reasons, but that's kind of where we got to. And so you wonder why the price of energy is going up. In other words, this damage was self-inflicted. Now, Russia is happy to supply all the oil and natural gas we want. Russia hasn't cut off oil exports. They did reduce natural gas exports slightly to Poland and Finland. Of course, that was a political message. The message to Poland was, hey, stop being a transit point for arms to Ukraine. And the message to Finland was, don't even think about joining NATO. Okay, so those are political points. But the main flow of natural gas to West Germany, Italy, and to a lesser extent, France, Eastern Europe, Romania, and elsewhere has not been interrupted. I mean, the irony is, you hear a lot about it, the G7 message, we're going to end Russian exports of coal. And then the EU met and we're going to end imports of Russian oil. And we're going to work on getting rid of Russian natural gas, et cetera. These are all announcements. None of them are in effect. This is all talk. The coal ban, so-called, we have our energy czar, climate czar, sort of a fraud, John Kerry flying around his private jet, trying to get rid of CO2 emissions. But that doesn't take effect until the end of August, if it ever does. The end of the Russian oil by ship, they're still sending it in by pipeline because Hungary insisted. That doesn't take effect until December 31st. And in the meantime, the oil and natural gas is still flowing. Germany's still paying Russia for the oil and natural gas. Putin's taking in $21 billion of hard currency, dollars and euros per month. And those amounts are not frozen. There's limits on what he can do with it, but he's getting the money. And Russia's paying Ukraine transit fees because most of the pipelines run through Ukraine. So here you have West Germany financing Russia's pursuit of the war and Russia financing Ukraine's pursuit of the war, all in the interest of keeping the oil and natural gas flowing, which they are. Now, we'll see what happens later this year, but I think my view is that it was sort of a bet that maybe the war would be over by then and you wouldn't actually have to do any of this stuff. But don't be misled by the headlines because they're, again, this narrative, but they're not actually doing it. So the point being, the price increase at the pump and the inflation in the US has very little to do with Putin and everything to do with the US handicapping its own energy industry, begging dictators for oil, and the influence of the climate alarmists. And by the way, don't underestimate the extent to which the climate alarmists who surround Biden, although I should include Gillian Tett of the Financial Times, but that whole crowd want higher gas prices. They want gas to be $7, $8, $9 a gallon because they expect that will accelerate the transfer to electric vehicles and make the electric vehicle more attractive relative to the internal combustion engine. Now that's another fantasy. It won't happen. We don't have time to go through all the physics of it. Output of energy by weight, gasoline compared to batteries and the pollution of batteries and the fact that, we don't have the charging stations. And even if we did, where's that electricity coming from? Oh, coal.
It's a false economy.
Yes, it is, but it's worse than that. It's actually not in the feasible set. It will never happen, but they're pretending. But meanwhile, they're destroying the U.S. economy in pursuit of an ideological point that will never actually happen. Another example of propaganda versus reality. So most of this has very little to do with Putin, everything to do with hidden agendas from the Green News scam and self-inflicted damage from the White House.
My many thanks to Jim Rickards for his keen insights, and you can catch my full interview with him where I ask him what all this manipulation and doublespeak means for financial markets and geopolitics, including his thoughts on the Russia-Ukraine war, only on GoldCore TV, which is due to be released on Monday. And if it's Monday already, You can catch it now. Still to come, Jim Rickards will play Fire, Hire, Admire, where he tells us just how he feels about some of the world's leading policymakers and so-called experts. But next up, we delve into technical analysis for ChartWatch with Gareth Soloway of InTheMoneyStocks.com. Gareth, what are the charts suggesting are in store for gold and silver, and what else should we be keeping an eye out for at the moment?
Hey, Dave, great to talk to you and great to do some chart analysis for your viewers. So what we're going to do is we're going to take a look at the gold and silver chart, maybe go into a couple other charts out there. But the bottom line is gold is doing exactly what it should be doing. A lot of people out there have been so frustrated by the performance in gold. Why isn't it up more with all this inflation? Don't worry, it's picture perfect matching up to what happened in the early, mid, and late 70s, all right? So we are now entering the late 70s period. Inflation is mirroring that. And again, we're talking 1970s here, and you're just before a bigger move up, according to my analysis. And it's important to recognize that while gold is only fractionally higher on the year, and you can see it right here. I mean, if you go back to January, we were right around here. So, I mean, you're literally just slightly positive, but compare that to Bitcoin down massively. Compare that to the stock market, the S&P and the NASDAQ down massively. And there's a whole lot of investors that would be very happy to have been all in on gold. Now, I never recommend all in on anything. Diversification is the lifeblood of successful investing. But let's take a look at the chart, right? So you had this beautiful consolidation pattern. This is called a wedge pattern. You clearly broke out on the chart here, moving up into what's called a double top, the high from 2020, mirroring the high right here. You then have pulled back to what we call the scene of the crime. Major support. This is a very common retrace on the charts. Now, from that point on, you're just consolidating here. To me, this is getting ready for the next leg up as it kind of gets its strength back. So the big move up took a lot of energy. It's come back in. Now you're kind of settling in. And the key catalyst here for upside in gold, in my opinion, is going to be the realization that you not only have a likely recession, which is going to be bad for stocks, but also you have inflation that's going to remain sticky at 4 to 5% for the longer term. All right, so you talk about wage inflation. We've seen massive amounts of wages going up. That, again, is not passed in one swell swoop, right? You're talking about wages. A business can only pass a percentage of the wage hikes through to the goods that are there being sold in a little bit of time, right? So every year they up it by just a little bit. So that's going to lead you to the next leg, to the upside on gold. And again, it's important to look at how well gold has performed. If you look at purely this chart on gold, it's not that impressive, right? But when you think about the dollar, look at the dollar, folks. The dollar has ripped up this year. In 2022, the dollar started out down here. It's gone all the way up here. Usually gold gets crushed in a rising dollar environment. We've seen gold hold steady and even being positive for the year. Then take a look at the 10-year yield. What's the 10-year yield done? And we all know what this has done, right? The 10-year yield since the beginning of the year has skyrocketed, basically over 100% to the upside, starting the year right around 1.45% on the 10-year, topping out above 1.5% or 3.5% here. It's pulled back recently, but again, same thing. In general, gold goes down in a rising rate environment. That's not happening. And so what this is telling you is that when rates start to come in, when you ultimately have the dollar starting to fade, that's where the next big leg starts in the gold chart. So again, look for later this year, the gold chart to really rip to the upside. I think you easily take out this high at 2070 on the gold spot price, and likely could even get as high as 23 to 2400 by year end, if not early 2023. Let's now take a look at the silver chart. All right, the silver chart continuing to hammer on major support. The silver chart's important to recognize. So number one, there's been no breakout on silver yet, right? You can still see the wedge pattern, this down sloping trend line, this flat line on the bottom. It's still inside of that range. Now you might say, why hasn't silver broken out yet? And the answer is simply that silver is also an industrial metal. And if we are headed towards a recession, then silver is going to have a harder time breaking out, because again, the industrial side of silver is going to suffer. Now, ultimately, do I think all commodities are likely headed up? Maybe not oil. I think oil is ultimately going to come in quite a bit more than where it is based on the recession and potential global recession that's looming. But I think even silver will eventually break out. When it breaks out, you are going to see, in my opinion, a measured move. This is a classic measured move, kind of calculation move. So basically a measured move, you take the low down here, which was right around $11.50, $12. We'll call it $12. The high here was around 30. So that's an $18 move to the upside. When you break out, you're going to take the lowest point on silver and add $18 to the upside. Essentially, this up move here would be mirrored by whatever the low is over here, $18 to the upside. Now, again, we've got to see this start to break out, but this is a classic measured move kind of chart formation. And again, that does put us right now probably at close to a $40 target on silver. All right. Now, when could that be achieved? Right. I mean, that's the big question. My guess is you have 1 to 2 years out that it could take a little bit of time as we kind of get through this period of worry about the economy and the industrial side of silver. But really, if you're thinking about the type of move here, if you get that in 12 months or even 16 or 18 months, that is a fantastic return on silver. There's a lot of shorts in silver as well. Once it breaks out, you're going to start to see it make a massive move. All right, couple other things to go over here. I think we have to talk about the oil trade here. And the oil trade, again, so many talking heads, so bullish. I've gone on record and said there's no way oil is going to break up when we were up here. In fact, I was short oil up here. This is a classic bearish setup where you have this big pop and reversal and then lots of inside bar action. All of this is kind of using up energy as it's taking so long just to get back to its recent highs. You have this beautiful trend line right here, this shorter term trend line, and this double top. And ultimately what we saw was you have an upsloping trend line connecting these lows, and look at where price went. Eventually, the chart dictates this will break to the downside. All the talking heads, analysts out there, so bullish on energy over the last month, 2 months, 3 months. And all I could see for myself was that the charts were telling me bearish, right? And just think logically, if we are in a rising rate environment, what's the purpose of that? It's to slow the economy down, to bring down inflation. And if you slow the economy down, if you slow the global economy down, is oil demand going to go up or down? The answer is down, and that means prices are going to decline. So again, basically, I'm not in my short anymore on oil, but if it bounces back here, let's say 110 to 112, I would absolutely consider getting in a short again. Just my personal opinion of what I'm looking to do, but that's where we are. So Dave, I hope all the best. I wish you all the best, and I look forward to talking again. Thank you.
Thanks for that, Gareth. And there certainly was plenty in there for us all to take into next week. Be sure to let us know if there's anything you'd like Gareth to look at for the next episode of the M3 report. Gareth talked a lot about gold and silver there, and that's great because that's our area of interest and expertise. GoldCore is your precious metal specialist, and we're here for all of your gold, silver, platinum, and palladium needs. From gold Britannias to silver eagles, from fully allocated, fully segregated gold coins and bars stored in specialist high-security vaults around the globe, we've got you covered. Simply head over to goldcore.com now and sign up to get started. My colleagues are a friendly bunch, and they're happy to answer any questions that you might have. And now to possibly my favorite part of the show. No, not the end, but rather the feature that will take us to the end of the M3 Report's maiden episode. Yes, it's Hire, Fire, and Admire. This is where we ask our guests who they would most like to fire from their current role, hire to any role of their choice, and who they most admire. It's a little bit of fun, but I'm sure it also gives some good insights as to how various experts are considered by their peers. If you've enjoyed the show, had a nap during the show, or want to share the show, please let us know either in the comments below or by tweeting us at GoldCore or by using the hashtag TM3R. That's all from me, Dave Russell, and I'll leave you with Jim Rickards playing Hire, Fire, and Admire. Be sure to like, share, and comment on this video to let us know what you thought. And don't forget to hit the notification bell to get notified for the next episode. Until next time.
I would fire, and I'd be polite about it, and we'd find a way to finesse it. But I would ask Janet Yellen to go back to Berkeley or wherever she lives these days. Janet Yellen was basically a labor economist and a statistics geek, and that's a big part of the Berkeley University of California, Berkeley culture. So a labor economist, statistics geek. How did she ever get to be chairman of the Fed? She doesn't understand anything about monetary policy or international monetary economics, but she kind of bumbled her way through it. And now she's Secretary of the Treasury, which is even more, has even more of an international orientation, because you have to worry about the dollar, which is compared to every other currency in the world or every other major trading partner in the world. She doesn't know what she's doing, so she should leave. The person I would hire is Peter Navarro. He was the chief trade advisor in the Trump administration. He's one of the very few who is, he has a PhD in economics from Harvard, so he's not some amateur, but he rejects most of the conventional analysis, which is smart. That shows you how intelligent he is, and is cold-eyed, clear-eyed, and cold-blooded, I should say, about the threat from China, what needs to be done on the trade front. Unfortunately, the Biden FBI led him away in leg irons the other day, but I would, I'd put him in the most critical trade advisory position, or maybe even national head of the National Economic Council, because I think he's that talented. Henry Kissinger, he's 99 years old. He was on a Zoom call the other day talking about American foreign policy, national security in China. I'm like, yeah, first of all, you hope you live that long. Or if you do, you hope you're still in demand, which he is. I was in China. I've been going to China for well over 30 years at this point. And I was there on some trip in the 90s. And one of the Communist Party officials that I meet with said to me, Jim, we love Henry Kissinger. He did the breakthrough with Richard Nixon, 1972 and all that. But don't you guys have anybody else? Kissinger keeps getting older. He's 99. He's still active. But they look at, Hillary Clinton, Jake Sullivan, Tony Blinken, even Madeleine Albright. It's been one clown show after another, and they keep waiting for, George Shultz, I would put on the same part, but George Shultz is, I think, 101. The only other figure who's comparable is James Baker, who's well into his kind of mid to late 80s at this point. But the Chinese are sitting there like, don't you have anybody else? And unfortunately, the answer is no.